And let me just introduce very briefly the three panelists who are here with us today. On my far left is Brian Fabbri, who's the chief U.S. economist for North America for BNP Paribas. To his right is Larry Kantor, his chief of research, head of research for Barclays. And immediately to my left is Mark Chandler, global head of currency strategy at Brown Brothers Harriman. What's interesting about this group is that every one of them has at least 2 graduate degrees. 2 of them have worked at the Federal Reserve, so you've got considerable economic knowledge in this panel. We're going to break this promptly at 11:45, so everybody can get over to the Waldorf Astoria for lunch. Those of you that have luggage here, there is a green room which is out behind these 2 doors to the right. That room will be locked, so if you want to put your luggage in there while you go to the Waldorf Astoria and have lunch, you may do so. So, without any further delays, Brian, do you want to start off?
Be delighted to, thank you. Well, I want to start off on a positive note. The world is recovering today, this quarter, from probably what one will regard as the deepest and longest economic recession that we've had since the Great Depression. The story, I think, is quite positive as we start to think about where we are relative to where we were. Financial markets have essentially recovered almost in all categories, especially in the United States and especially in the corporate bond markets. There's one major exception, which I'll talk about in a couple of minutes. And as a result, we're likely to see GDP grow, well, maybe 3.5%, even 4% in the second half of this year. Largely, it's a statistical thing. Businesses decided that they didn't need all of the inventories that they had at the end of last year, and so frankly, without any new financing, they just worked down their inventories. Production and trade dropped everywhere around the world, and then consequently, it has to start up. It did. I mean, the auto industry is a great example of how this all worked. Remember, the auto industry stopped production in May and June, and then all of a sudden it started it up in the end of July, and consequently, the numbers here, but really everywhere, looked like a steep decline in the first half of the year, and now it's going to look like a relatively steep increase in terms of industrial production, in terms of economic trade, global economic trade, and so on, and everyone is participating around the world and to some degree in this pickup. Don't forget, we also have lots of fiscal and monetary stimulus in place. The government, as you know, created 2 fiscal stimulus packages. They provided some strength to consumer spending power, certainly in the spring of both of the past 2 years, and consequently, there's still some monies left in that fiscal stimulus package to be used. But once it's all gone, and certainly the Fed was responsible for creating all kinds of wonderful, innovative strategies to avoid financial catastrophe. But once this ends, Fed stops buying in December securities, most of the fiscal stimulus runs out, then we start thinking about next year. And that's really the title of my theme, what happens next year? Not just here, but to all of the advanced economies around the world. What happens? Where's the new stimulus to come from? Ordinarily, we would have to think about creation of jobs, creation of income for consumers to spend, and so on. And frankly, I think that's one of the problems that we will have. We're not likely to see significant job creation over the next couple of years. It's that way almost every cycle. We've gone through the last 2 cycles when we used to, and I remember writing these things, I'm sure Larry did too, the jobless recovery in the 1990s, and then last one was the job loss recovery in the 2002-2003 experience. So we really don't create lots of jobs when the economy starts to grow, and I think that's going to be very present right now. Since consumption is 71% of GDP, if we don't consume, we're not growing very fast. If government stops stimulating, I think that there's got to be something that takes its place, or else government comes back, and indeed it's my own view that I think we wind up with another fiscal stimulus package somewhere early next year. I think the Federal Reserve will continue to have to stimulate by buying more mortgage-backed securities, and then they'll all have to decide what to do about the commercial real estate problem that's looming. We think it's a very big problem because commercial real estate, vacancy rates are rising, prices on real estate or commercial real estate are falling, and it's sort of the same thing that happened in the residential markets, only it's confined mainly to small and regional banks around the country. So indeed, there may well be a lot of those banks going out. FDIC will have to step up and take the brunt of that. They'll have to finance those buyouts or bailouts. And frankly, we'll be back in yet another situation. I guess my lackluster, really, the story boils down to this. We had a financial problem that we allowed ourselves to get into during most of the years of this decade. We built up leverage to unprecedented proportions, and we yet have not deleveraged sufficiently. And until that deleveraging really takes place, it'll continue to be a weight on GDP growth going forward. When we look at the rest of the world, Japan is in even bigger trouble. They're already in deflation. They're likely to stay in it. They don't really have the capacity for a lot of stimulus, and they've used up a lot of their personal savings wealth. Secondly, Europe. We think Europe's just about ready to start tightening things again, and we think it may even start by monetary policy measures before this year is over. And so therefore, when you think about Europe, once again, their potential for growth is even more limited than our own. They never really did manage a macro fiscal stimulus policy like we were able to produce. And consequently, their growth rates look really, really fragile. In fact, our own views about Europe are they barely grow next year. Where's the growth? Where's the good news? China. If you have a command-based economy, you just basically say, here's the stimulus, here's the money, start building. And basically builders, contractors, and everyone else went out and did it. And then they flooded the banks with liquidity. And unlike our own situation where banks basically held back, didn't use all the excess reserves, they went out and flooded the market with liquidity. And consequently, China's growing, in our judgment, over 9%. They really never fell into recession. But they now have another problem. Too much liquidity in China. Money growth, credit growth, everything is growing 30, 35%, and consequently, even they may have to start thinking about taking something off the table. So China is definitely growing. It's helping out the emerging world, and there's a big separation, in our view, between what goes on in emerging market countries' economies and advanced economies. The advanced ones are stuck in a rut. The emerging ones are growing pretty rapidly, and that's where we think you ought to put your money.
Great. Larry?
Okay, well, maybe we can make things interesting because I've got a different view than that, and
that's what makes economists.
So we can have a nice discussion and hopefully get some audience participation and some Q&A. I mean, the way we're looking at things is that we're in the midst of what I think will turn out to be, once all the data are in, a classic V-shaped recovery. What's interesting about it is that we've already pretty much seen it in Asia. The truth of the matter, the Asia story is kind of old because, as Brian pointed out, it's actually not that China's going to take some actions to slow things down. They already have. And in fact, you can see it in the data that they've slowed things down. In our view, that's a good thing. And it's a good thing because, China doesn't release quarter-on-quarter GDP statistics, so you have to kind of interpolate it. But by our estimates, and this is consistent with most people's estimates, GDP growth in the second quarter was something like 16% at an annual rate. And even for a country like China, that's way above what they can do on a sustainable basis. I would say by their definition, they probably did go in recession because quarter-on-quarter growth slowed to as little as 5 or 6%, which by China's standards is way below potential. They did unleash quite a bit of credit growth, although it's important even to put that in context because unlike the rest of the world, before the crisis hit, China was actually restraining credit growth. So there was much more scope for growth. And then when you also consider that China, nobody would argue with this, has massive infrastructure needs in terms of the need to build highways and schools and electronic circuits and the like, and no one would also doubt that they don't have the wherewithal to spend this money. So in our view, the fact that the Chinese authorities are taking action at a relatively early stage to slow things down at a more sustainable rate is good because if they didn't do that, they'd need a much more abrupt and I would think much more destructive policy tightening later down the road. But China's not the whole story. If you look at almost every country in Asia, it looks like a V. Japan's a bit of a different story, but whether you're looking at Singapore, Hong Kong, Taiwan, across the board, Korea certainly. In fact, Korea, right now, it looks like the V is pretty much complete. In other words, they've regained all of the lost output and is, we think, on the verge of slowing to a more sustainable pace. The interesting thing is that no one is extrapolating this to the more developed countries like the United States and countries in Europe. If you look at where GDP growth is right now in countries like Germany and France, it looks like it's around, it has a 3 handle or so, 3.5% or so. In countries like Germany and France, that's actually above trend. That's a rapid rate of growth for those countries. Then, of course, we move to the U.S., although I agree with Brian, I don't think that growth is going to be strong on a sustained basis in most European countries. But I do think it's happening in the U.S., which is a contentious point, and I recognize that most people don't believe that this is the case. One thing I want to talk about, though, is a little bit about inventories, because as Brian said, that is a big part of the story. Brian referred to this as statistical. I hear a lot of people say this is a technical thing. I don't know if it was statistical and it was technical, why wasn't everybody saying that on the downside? The truth of the matter is that inventories played a huge role in the decline in GDP. And it is playing, or actually it's forthcoming, most of it, a big role in the increase, and it always does, always. Go back and look at every single economic cycle, and you'll see that inventories play a very big role. And by the way, we're in the midst of the mother of all inventory cycles. This one's bigger than any of the others because we had a much bigger panic effect, both on the part of demand and then the response of firms. When you get in a recession, and this was a real recession, firms go into survival mode. And what they do following the collapse in demand is they cut output drastically. They want to get their inventories down to as low as possible. They cut payments to suppliers. They shut plants. They lay off employees, and they did it big time. Then what happens is demand stabilizes at a low level, which actually happened around the turn of the year. It's still weak, but it's grown a little bit, but it's at low levels. But output just kept falling. And as Brian says, the auto sector is a great example of this, where you get to a point where production is so far below spending that you've got to catch up. That's what starts it. It's not the consumer. The consumer never leads you out. It's when firms have to rebuild output, which cuts the layoffs and even causes hiring and so forth, an increase in hours. That's how the process started. That's what's happening this time. So now, if you go back and look at the patterns of business cycles, and in my view, we haven't had a real recession in over 25 years. Brian talks about the jobless recovery, and he's right. The last 2 recoveries had very little job growth, and in some cases, Brian noted, job losses. But in my view, that's because they weren't real recessions. The last US recession, so-called recession in 2000, 2001, do you know we didn't even get 2 consecutive quarters of negative GDP, and GDP was never negative year on year. Housing and autos, the 2 most cyclical sectors in the economy, never even went down in the last recession. This was a real old-fashioned recession, and we lost millions of jobs. The unemployment rate went up 5 percentage points or so in a year. That's what happens. It feels like the world is ending. And when that happens, because employers are so drastic in cutting workers, to rebuild output, they got to bring workers back on. We'll get the test of this pretty soon. If I'm right, by the end of the year, you should see net job growth before the end of this year, and we're getting pretty close. There's only 4 more employment reports to go. If job growth is still negative through the end of the year, especially if it's significantly negative, then we are going to have a problem because the consumer is unlikely to come back. If the labor market doesn't come back, it'll stay weak. Right now, though, and this is important, you don't need strength in the consumer, okay? So if you look at the other 30% of the economy, it looks like it always looks after a big downturn. It looks exactly like a V, okay? Inventories, so basically they fell almost $160 billion in real terms in the second quarter. What does that mean? What is that? Inventories are just the difference between spending and output. So if spending's 100 and output's 20, inventories of 80, inventories fall by 20. How big is that? Just to get output back up to spending. If spending doesn't increase at all, you're talking about more than 5.5 percentage points of GDP. It's huge. Housing. What's going on in housing activity? And this is maybe a word that's going to shock all of you. In growth rate terms, it's booming. Single-family housing starts already are almost 40% above the bottom. Is that a great level? No, it's very, very weak. It's just that we got to practically zero. That's what happens in big recessions, and that's what's going on now. Trade. Okay, for the first time in I don't know how many years, trade is actually adding to growth, mostly because of A, a very cheap dollar, and B, because the US, contrary to previous business cycles, was the last out. So we've got strong export growth and relatively weak import growth. Even CapEx, which tends to lag the cycle, in fact, in most recessions it declines for a year, is going to turn positive, judging by capital goods orders. So the big negatives are over. This is important, okay, all these things. For example, residential construction had been subtracting a full percentage point from GDP growth on average every quarter for 3 years. As soon as the second half of this year, you're going to see a positive. That's a positive growth. That's a very big swing. So you are going to see a V. You're probably going to see in the second half of this year somewhere between 4 and 5% US GDP growth. And by the way, that wouldn't be all that spectacular given how hard we fell before, but it's going to feel a lot better. Let me end here because I don't want to overdo my time here. What's the big risk to markets? I would venture to say that most of you would say that it's going to be that the recovery falters. Okay, it's not going to be as strong as you think. I think that those concerns are misplaced. This recovery is anything but fragile. It's spreading around the world. You've got the big inventory cycle. The cyclical sectors are coming back, and there's tons of policy in the pipeline. Not only are rates about zero, the Fed still has another $500 billion or so of securities to buy. That's not the risk. The risk is that when people recognize that this is a real recovery, they're going to also realize that crisis settings for policy, which is where we are now, are no longer appropriate. And when that happens, in conjunction with the Fed not buying these securities anymore, you're going to get a very sizable rise in interest rates, and that is going to make the going a lot tougher when it comes to financial markets. So I'll just stop there.
Mark.
It's hard to follow that. I guess I come from a little different perspective, but I would say that generally, as far as the sort of the debate between two former Fed economists, I'm sort of in the middle. I should be, I guess, is I do believe what Larry was saying, that we get a much stronger recovery than people expect, not just for the second half of this year, probably into the first half of next year. A lot of the fiscal stimulus is still in the pipeline. It still hasn't been spent, will be spent next year. So I generally agree, more bullish on the economy. But what I really like to do is talk about put these things into a global context. As a currency strategist, that's where I really spend my time. When you buy a bond or you buy a stock, you could always sell it and buy another asset class. But when you sell the currencies, you've got to stay in the currency universe. There's no such thing as getting out of the currency universe. And so I really would like to do is just spend my few minutes here just explaining why I am, despite all the pessimism about the US dollar, central banks diversifying reserves. We heard from the earlier panel that our model of what someone said was laissez-faire capitalism is over. For me, I don't know about this laissez-faire capitalism. It seems to me that we've never had that in the United States. Keynes writes a book in the 1930s saying the end of laissez-faire. So where are these people today saying this is the end of laissez-faire just because the government's getting more involved in the economy? Before this recession hit, there's different ways to measure the size of a government. One way to do it is expenditures as a percentage of GDP. Before this recession hit, the US government expenditures percentage of GDP was 33%. The government was already consuming a third of GDP before this crisis hit. So it looks like the role of government is going to increase on a semi-permanent basis, though not as big as it looks right now. But Europe is at 50% of GDP. And that's the other thing, I guess, that strikes me, is that we can look at our own navels and chastise ourselves for the light regulatory environment, for Federal Reserve keeping rates too low for too long. And yet many other countries in the world have been hit by a deeper economic downturn than the United States. Their banks were even more leveraged than ours. Look at European banks. Look at the UK banks, for example. The UK banks' assets were 4 times GDP. 4 times GDP of the UK. US bank assets, and that's with our 8,000 banks, less than 1 times GDP. Size matters. That means that we can have easier to absorb these problems. Think about those UK banks. A 5% drawdown in asset value, which is about what Bear Stearns experienced before they closed down their funds. 5% loss of UK banking assets cost them 20% of GDP. It's amazing, these numbers. We're nowhere close to that. The story I like to tell people about why I'm optimistic on the outlook for the, I would say, the durability of the dollar, durability of the United States economy within the world economy. A story about these 2 boys being chased by a tiger. One of the boys stops, puts on a pair of gym shoes. And his friend says, "What are you doing? You can't outrun a tiger by putting on running shoes." And his friend says, "I don't have to outrun the tiger. I just have to outrun you." And the point is that as bad as it looks like in the United States right now, I think that the United States is has the best chances of emerging from this crisis stronger than other countries. I think we'll emerge from this crisis like we emerged from the Great Depression, from World War II, stronger than we go into it. The reason we're going to be stronger is partly because our economic system is more flexible. I know many of you are thinking the flexibility of the labor markets. But this is how I experience the flexibility of the flexibility of labor markets. My boss can fire me for any good reason or any bad reason. I'm hired at will. That's the flexibility of labor markets. My father was a plumber. This is before they became drain surgeons, right? He was able to support a family of 6. One man's blue-collar income could support a family of 6 in the 1960s and 1970s. You can't do that anymore. The problem is not that these people who don't have income, jobs, or assets, these ninja loans, were pulling a fast one on Wall Street. The problem is that our means haven't kept pace with the American dream. The American dream is not having more shoes like my wife does, so Imelda Marcos comes over to the house and borrows shoes. Right? The American dream is having a house, having kids that go to college. That American dream, as TIA CREF knows, if you look at their website, tells you how much it costs to send a kid to college today. It's beyond the range of most Americans. Family income in the US, median family income is not much more than $50,000. How do you spend $250,000 to send 1 kid to college? Problem is, here's how I sort of see the problem. My father had an income that was kept pace with inflation or productivity. That was decoupled sometime in the early 1970s. So out of all the goods and services the US produces, one of the things we produce very well, we could turn a necessity into a virtue. And what we did is after the early 70s, when males' income no longer kept pace with inflation or productivity, we sent women into the workforce. That's a good thing, right? The family is working more hours. That's how the family began making ends meet. Then, adolescent children began working at an earlier age. That still wasn't enough to make ends meet. How do we make ends meet? Credit card. And so the American consumer, American household, the American worker was at a disadvantage in this crisis. This is why Studs Terkel, his book about the Great Depression, wasn't called the Great Depression. It was called Hard Times. Because for most people, it wasn't a depression, it was just more hard times. Same thing with this crisis. Yes, there's a lot of Americans that are out of work, though most Americans in the workforce are employed. Most people are making their mortgage payments. For me, the crisis is is a systematic problem of wages not keeping pace with inflation or productivity. That's because our employers, our socioeconomic elite, since America, of course, doesn't have classes, have been so, and this is part of the problem. This is what's happened. This is why I'm positive on the economy, like Larry. I think what's happened is our employers have been ruthless. As much as they cut production, they've cut workers even quicker. So what this means, productivity has gone up. You know, our jobs are not being lost to China. China is losing manufacturing jobs as well. Most major industrialized countries are losing manufacturing jobs. This is a good thing, because people are being replaced by machines, technology, productivity. You know, I think about the, you know, when I was younger, I used to want a secretary. Remind me when my anniversary is, do my typing, right? Where have all the secretaries gone? I think they've gone to Puerto Rico or China. No, they've been replaced by Bill Gates' Microsoft Office suites. What about bank tellers? All these bank tellers. We don't have as many bank tellers in New York or any of the major financial centers anymore. Where'd they all go? They go to China? No. They've been replaced by ATM machines. This is a good thing. What makes me optimistic about the United States is that the dollar, we've survived this crisis, and the dollar today is as important in the world economy as it was 20 years ago. Many people talk about the Chinese. You know, we're getting ready for this G20 meeting. People say, well, the Chinese are talking about SDRs, reform of the international monetary regime. When we know very well when our politicians are lying in the United States, right? Because their lips move, right? But somehow, when politicians in other countries speak, we take them at face value. So the Chinese talk about moving out of the dollar. But here's what they've done. Since the middle of last year, I should say in June, end of June of last year, the Chinese reserves, which they don't tell us how they're allocated by currency, but the US Treasury data showed that the Chinese owned roughly, out of their reserves, about 27% of them were in US Treasuries. At the end of June of this year, about 36% of them were in Treasuries. There is no evidence whatsoever from the IMF data, which is the most authoritative source, that central banks have diversified their reserves out of the dollar. Roughly speaking, the dollar is 2/3 of reserves today. It was 2/3 of reserves in the early 1990s before they run up to the Eurozone. The euro, back in 1999 when the euro was born, many people were writing at the time that the euro was going to replace the dollar. The euro today is slightly bigger than the sum of its parts. Its parts, the écu, the Deutschmark, and the French franc. Not only is the dollar the world's key reserve currency, but it's also a very important invoicing currency. When China buys iron ore from Australia, they pay US dollars. Not only commodities, from energy, the hydrocarbons, precious metals, industrial metals, food and fibers, all quoted in dollars. But many countries, look at Italy for example, they have the euro. 51% of Italy's exports are invoiced in US dollars. The bulk of South Korea, Taiwan, Malaysia, Singapore's exports are invoiced in US dollars. I think that it's right for China and India, China, Japan, India, Russia to say there's not much of an alternative for their reserves. They have too many of them because they're so reliant on exports. Look at what happened earlier this week, Kazakhstan. They said they have roughly $17 billion in reserves. They say they'd like to move them, but they don't have an alternative. I say, come on, seriously? Any country, look at Canada, our biggest trading partner. Over half of their reserves are not in dollars. Something like 26 billion of their reserves, half of them, are not in US dollars. Surely Kazakhstan has a choice. China might not have a choice. I say too bad. They rely on exports. They export roughly 40% of GDP. So does Germany, export about 40% of GDP. What we've developed in the world is the imbalance. Can you imagine what's going to happen at this G20 meeting? Treasury Secretary Geithner will tell the G20 something like this, sort of in my fantasy. He'll say, you know, you people have been complaining about the overspending of the US consumer for a couple of decades now. And here's the good news. The American consumer is pulling back. They're deleveraging. Right? I agree with Brian. The country as a whole is not deleveraging because we're transferring the debt from the consumer sector, household sector, to the government sector. The country as a whole is not deleveraging, but the American consumer is. They say, this is what we're doing about the large deficit. We're reining in the American consumer. He says, and now we'd like to hear what you people, what you Europeans, the other G20 members are going to do about the global imbalances. Merkel, who's running for re-election in Germany, who's going to be at the Pittsburgh G20 photo opportunity, she's going to say something like, I'm sorry, but Germany is committed to our export engine. We have rising unemployment. What else can we do? We export. That's what we Germans do. The Chinese are going to say the same thing. We have 800 million people in the rural communities living in abject poverty. We can't give up our export-led machine. How are the global imbalances going to change? Frankly, I don't think they will. And this is really my answer to some of the problems, some of the structural problems that Brian pointed out. I think it's the old classical political scientist answer for these problems. I think this is the most likely outcome. Muddle through. Thank you.
Great. Well, that may be the most optimistic statement we'll hear for a while, muddle through. Some economic observers suggest, though, that we in this country need to begin slowly but steadily rebalancing our economy. So we increase savings, therefore have more money to invest, and therefore there has to be a modest contraction of consumption. What specific policies would you recommend that our government, both at the Fed and at the budget level, pursue in order to achieve that objective, assuming you agree it's a good objective?
My view is I get a little nervous when the thing is framed as if government has to solve this problem. I think there's just as much risk when you get the government involved in something like this. They're going to make the problem worse rather than actually improve it. And I think this is already happening. Mark was talking about why the consumers went to debt because they couldn't afford college and stuff like that. But the truth of the matter is that assets were growing in value much faster than liabilities. So they had a very big increase in wealth, and real interest rates were unusually low. And lenders were falling all over themselves to provide credit at incredibly favorable terms. So, at the time, it seemed like a good idea. Where have you heard that before? It's very easy after the fact to say this was a bad idea, but at the time, it actually worked quite well. In other words, it was kind of smart if your house doubled in price to take a home equity loan out at an after-tax rate of 2% or 2.5% and put it in a private equity fund that was going up 30%. By the way, a lot of people did that.
But not really a majority of Americans didn't do that.
In fact, the idea that it was the low-income people just trying to make it that took these home equity loans out is actually wrong. If you look at the data, the vast bulk was taken out by very high-income individuals, and a lot of it was doing that or buying second homes and things like that. And part of the proof is that when home equity loans collapsed, consumption didn't. Consumption collapsed a lot later than home equity loans. So now if you ask, so to me what's happening is, Brian's talked about deleveraging and he's right, and Mark, you referred to it. To me, most of that's happened already. The saving rate's gone from 0 to 5% remarkably quickly, partly I think because of the sort of panic effect. It's sort of a debatable thing, and economists disagree about where it's going to go. I think the long-term average, depending on which period you look, is something like 7%. 8%. My own guess is that it'll probably drift up a bit more, but most of the deleveraging's happening. Remember also that there's a whole corporate sector out there. It's not just the house. This recession was a household recession. The last one, 2000, 2001, was a corporate one. If you look at the non-financial corporate sector, what you'll find is that their balance sheets are in incredibly good shape. As a matter of fact, the financing gap right now is positive. In other words, cash flow is bigger than CapEx. So they can easily self-fund, and there's no problem with the balance sheet. In terms of, we may be, I don't know, one of the only countries in the world, if not the only country, that taxes savings and gives incentives for borrowing. Now, we've lowered those incentives, but you can still deduct any interest associated with a home, but your savings gets taxed. So, the thing is this will never happen for political reasons, but